Hey everyone, all of the Canadian banks have been reporting their earnings in the last week or so. So in today's video, we're going to look at three of those banks that have actually increased their dividends out of those earnings reports. We're going to talk about what these banks are. We're going to talk about some of the differences between these banks and ultimately how much they increased their dividends by. So we're going to start here with number one, TD Bank. TD Bank has a starting dividend yield of 5%. So that's something to note off the bat. Lots of these banks already have really healthy dividend yields going into earnings, but they still increase them despite the starting yields being at pretty high levels historically speaking. So 5% starting yield on TD Bank. Looking at TD Bank in the last year here, down about 10%. It's been a choppy ride for the banks overall. You can see in February when it was that regional bank crisis in the US, a big dip in the price of shares. Has never recovered back to that level of 90 plus since then, just because there's been other macroeconomic headwinds that have kind of softened that recovery. But ultimately, the bank is still cranking out tons of profits. We're going to look at some of their performance here. But before that, just wanted to share a bit more about TD Bank in terms of where they operate, how they operate. On the map here, you can see where they have all of their retail locations, over 2,200 across North America. And they just kind of break out here what goes into retail banking versus wealth versus wholesale banking, just as some background for those of you who may not be as familiar with the sector. But ultimately, TD Bank is a really large retail operation relative to lots of their peers, where Royal Bank has a lot of wealth management and capital markets that tends to be more volatile, really roaring in good times, declining in bad times. TD's a lot more centered around retail consumers and stuff like that, which tends to be less volatile. And that's one of the reasons I like this bank, and I actually own shares of TD here. Going into their performance in the last quarter. So here's their P&L. Their revenues were up 3% quarter over quarter, 17% year over year. So not too bad on top line. Where we start to see some issues is provisions for credit loans. That's money they're putting aside because they may have some bad debts, concerns they're not going to get some of their loans paid back. This is a pretty material increase. So over $167 million versus last quarter, almost $500 million versus last year, and it's pretty much doubled versus last year. So that was a pretty big number there. And then just general expenses went up pretty high to 24% year over year. We're seeing lots of companies have expense control problems with labor costs going up, inflation that also hits these corporations. So ultimately, net income ticked in at just under $3 billion, which was 8% down from a year ago, diluted EPS of 157, and then return on equity down as well. On an adjusted basis, about 14%, so down 2% versus the prior year. So we're starting to see some cracks here. Return on equity is going down, provision for credit loans going up, expenses going up, outpacing revenues. That's compressing EPS, right? And the bank's definitely feeling it. One of the areas, they don't show the 2023 number, but I think aside from their stake in Schwab, the US retail bank went down about 10-11% in terms of the numbers that they were doing versus 2022. So this has been an area that's actually been growing over the years from 3.2, 3.7, lots of adjustments during the pandemic year, up to $4 billion and $4.4 billion. Starting to see that come back a bit, despite that being a really good growth engine over the medium term for the bank. So that's where lots of investors were looking, and one of the reasons why the stock actually got traded down a bit in the days after the earnings here, as you can see, still down over 1% on the week. And they've been making some other kind of conservative decisions on how they're managing the business because of this result and just kind of the cracks in their operation. They actually announced they were cutting over 3,000 jobs here, so 3,100 employees based on its third quarter total count. They're going to cut 3,100 more. They kind of presented it as a broader restructuring to drive efficiencies so they can invest in the future of the bank, blah, blah, blah. Every company does that when they do layoffs, but ultimately it's probably some profit pressure. And on top of this, they also said they think it's going to be concerning or challenging to hit their 2024 forecast, which I believe was $8.60 of EPS, which would have their current ratio trading at about 9.5 times PE. So they said that was going to be challenging. They may miss that by a bit. So that kind of conservative outlook paired with the fact they're cutting jobs, paired with some of the results we're starting to see some shakiness out of the banks, even though I personally think it's been already priced in throughout the year as the bank's down a pretty decent amount, with the broader market from a stock market perspective holding up decently. With all of that being said, they still increased the dividend. So the dividend went from 96 cents to $1.02. I just think that these banks have tons of room to continue to return capital to shareholders. Their dividend ratios or payout ratios are like in the 40s. They're trading at 10 times price to earnings. So they still have tons of capital that they're making on a quarterly and annual basis to reinvest in the business, do buybacks, do whatever else they want to do with their capital, and still increasing the dividend 6% doesn't really impact their ability to operate the business too much. So I think the fact that they're having all these issues, they still increase the dividend, just goes to show the strength of position overall that these banks are in, even if it's kind of cracking a bit versus last year. You can see here just the dividend growth over the years. They pretty much increase every single year. So was not surprised to see that 6% dividend increase despite some of the shaky performance that they reported. But ultimately, they did miss the numbers. While it's nice to get the dividend increase, hopefully the fundamentals of the business kind of continue to pick up in the quarters and year ahead. They didn't miss by too much. The market's not down too much on the week, just about 1.5 points. So slight miss for TD. Next stock is Canadian Imperial Bank of Commerce, also known as CIBC. They actually beat their numbers. You see they're roaring 5% up on the week. They had a much higher starting dividend, about 6.4%. Unlike TD, they have almost their entire business in Canada, and they have a very large mortgage book. They're very exposed to the Canadian housing market, and that's one of the reasons that they tend to trade at a bit of a lower PE here. But it was interesting to see that they kind of shocked the market with their performance. So let's take a look at what they reported. They had flat revenue. Net income was up 4% though, as they controlled their expenses really well, about flat year over year. Their quarter over quarter revenue is flat, but they actually grew 8% on revenue, controlled expenses really well. That drove an increase in income. So EPS up $1.53, so up 20%. Looking at their ROE, return on equity as well, just about 12%, even on an adjusted basis, 12%. So up slightly versus a year ago, but return on equity is in the low teens, especially when the cost of capital is where it is. I don't think is definitely where they want to be. They probably want to be at least mid-teens to high teens on these banks, historically speaking. So some more work to be done there to maximize, their return on investments and whatnot. Continuing to just summarize their earnings. So you could see overall in 2023, company made about $7 of earnings per share, $6.70, and the shares are trading at $56. So trading at about 8 times earnings based off of that look. And then revenue growth 7%, return on equity. We talked about some of the challenges that all the banks are having in that area. So that was kind of one of the more sore spots, I suppose. But overall, really strong top line performance from revenue and EPS being at that $6.70 level on an adjusted basis. In terms of what drove the differences on CIBC versus some of these other banks, one of it was the provisions for credit losses. So you can see here, very slight increase. So Q3, they had about $4 billion. Q4, they're at 4.1. So very slight increase, especially when compared to something like TD, where you saw it almost doubled versus the year prior, and hundreds of millions of dollars of increased provisions for credit loans. So they were able to manage their PCLs or ACLs a bit better. It's really hard to kind of uncover this though, because who knows who's being more conservative. Maybe TD was being a bit more aggressive on their assumptions and CIBC was being more conservative over the last year. So now TD's correcting, but CIBC doesn't have to or whatnot. So it's really hard to kind of unpack that. But overall, I think that was welcomed by investors. And then ultimately, they decided to increase their dividend from 87 cents to 90 cents. So about a 3.5% dividend increase, which doesn't sound like a lot. But once again, when your starting dividend yield is almost 6.5%, any increase in dividend is very good for an investor. You're already getting the starting yield of 6.5 points, and then you're also getting incremental dollars coming in now from that dividend increase. And that's just more and more confidence that the dividend is not going to get cut. If they're increasing the dividend payout, you should feel pretty good about the state of that dividend. And in addition to that, similar to TD, their payout ratios are in the same range, around 50%. So lots of room for them to continue to grow the business, protect their profit streams while paying out a few more percentage points to the investor. Going into the third stock here, it is Royal Bank of Canada. This is the largest bank in Canada. You can see $170 billion market cap. We'll talk about their layout in a minute. Looking at the stock over the last year, similar trend to TD, down about 9% here. They've rallied a bit in the last few weeks, but let's just see how they did right after earnings in the last 5 days. Yeah, they're up about 3%. So seems like they also had results that the market liked. Looking at their business here, they have a bit more complex of a business. In terms of their revenue streams that I'm circling in the middle, you can see their commercial banking unit is only about half of their business. They have a huge wealth management division that does almost as much revenue as commercial banking. And then capital markets is a big chunk for them too, at $2.6 billion. They also have a decently sized insurance business. I think it's about 5% of the company. So you can get a sense they're a much more well-diversified bank in terms of where they play in financials, but some of these are a lot more volatile, like wealth management. Sometimes depends on the returns that they're getting their investors or people that own the wealth that they're managing, in terms of how much profit that they take out of it. And then also capital markets is very dependent on the overall market. So some of these areas a lot more volatile than their commercial banking division. So that's just something to keep in mind when deciding what banks you want to be invested in or what your risk appetite is. Going over to their net income mix. So you can see here about half the business, commercial banking, and then half of it is between capital markets, wealth, and insurance. In terms of geography, 70% Canada, 15% US. I actually thought they would have been more US than that. And then 15% other international. I think they do own some wealth management assets in the UK and stuff like that. So they're a bit more geographically diversified than CIBC, maybe a bit so than TD, as TD primarily operates in North America, doesn't really have those overseas investments or divisions. And then in terms of their allowance for credit losses, or PCLs, ACLs, whatever you want to call it, they also had a pretty significant increase as well, up to $5.5 billion. So about 0.61%. That's higher than it was a year ago. A year ago, it was 0.5%. So very slight ticking up, but it's definitely kind of a sign of maybe some cracks starting to occur in the loan market and in the economy. So company continues to make lots of money here. Looking at their EPS, was about $10.50, down 5% from the prior year. So looking at their share price here, that is about 11 and a half times earnings trailing on the company. So a bit more expensive than CIBC, which was about 8.5. TD is 9.5 to 10, depending on where they land. Royal Bank has more diversification. It's a bigger business, and it demands a higher multiple of closer to 12 times. They had a starting dividend yield of 4.5%. And you can see here, they increased the dividend just 2% to $1.38. So the lowest dividend increase out of the three, but they do have a good starting yield, still of 4.5%. One thing that while looking at this here is, again, on a total year basis, you can see PCLs of $2 billion up from a year ago. That's a pretty material number, especially for a company. Even for a company that's $170 billion, $2 billion is notable on a single year basis. So that's something they got to watch. But what took me back is when looking at RBC, just the sheer size of this business, they made $15 billion in the year ending October 31st. And that was down about $1 billion from the year prior. So they're making over $1 billion a month in net income from their operation. This is a mammoth of a financial institution. And, over time, they've managed it really well, provided a lot of great value to shareholders let's look over the last 5 years, up 30%. So that's about 6% a year, and they're paying over 4% dividend yield. So they've been providing over 10% total returns. And when I just go all the way, you can kind of see long term if you're an investor in the banks, especially this bank, what kind of return you could have yielded over the last 10, 20 years, not including the dividend yield. So these are great businesses. They are carved out in a really great economy and a great geographical market in Canada that is growing with immigration and whatnot, pretty much have an oligopoly. So long term, I think trading at these PEs around 10, continuing to increase their dividend, invest in the business, buy back shares, I think these banks in this sector will continue to outperform the broader market. And these dividend increases are just kind of reinforcing their glide path to returning superior returns to shareholders. So thank you guys for watching this video. If you like this kind of content, be sure to give this video a big thumbs up. It really does help a ton with the YouTube algorithm. And so consider subscribing to the channel as well. We talk a lot about individual stocks, ETFs, overall portfolios and whatnot. So I'd love to have you along for the ride. Thanks, and I'll see you guys in the next one.